సరిపోదను పర్సెంటే ఉంది. Yeah, good afternoon, guys. The voice is clear. Okay, fine. In a previous class, we just revised our fundamental topics like cost of capital chapter related basics. Yeah. So the intention of the Akash, happy noon, happy Nana, happy. So when it come to previous class, cost of capital, the main intention of the cost of capital is a calculation of KO. Very clear? If you want KO calculation, you need to understand the specific cost. What are the sources you are using? Generally we have multiple sources in the market. Just for cost of capital purpose, we are focusing only 5 things. One is equity share capital, retained earnings, preference share capital, debenture, bank loan or term loan. Yes or no, sir? Everyone expecting something. We need to fulfill that something, right? Yes or no? So the fulfilling of something is nothing but a calculation of cost. Okay. Now, I think we completed KD calculation and KP calculation. Now K also we completed. One is pending is the realized yield. Realized yield. So before understanding the realized yield, just look this. This is your workbook. Our CMA board newly released for last attempt. So in this question, in this workbook, we have a new problem relating to KE calculation. Yeah, see here, illustration number 11. So these questions all are added in our new material. Don't worry. You need not to check again one workbook. I consider all questions in our new material. So new material is work in progress. That's why I'm presenting in workbook itself. Now let us look this. An analyst is examining a private firm under consideration as an acquisition and determine the following. The current capital structure is non-optimal because the owner avoids the use of debt. So the word of non-optimal is there now. You will get a clarity at the time of capital structure discussion. Okay. Now you can go with the not clear. Here itself, just go with the not clear. Okay. A small stock premium and company specific risk premium are determined because the private firm is such a smaller and such a less diversified than the public firms that beta is estimated from. So you have to understand that sentence. That is a concept, not a question, it's a concept. So what they are expressing the words, a small stock premium and company specific risk premium are determined because the private firm in such a smaller and such a less diversified than the public firm and the beta is estimated from. So at the time of concept explanation, I will give a clarity for that point also. It's a new point. Next, point 3, the industry risk premium reflects the additional risk in the industry compared to the broad market. This also you need to understand with help of concept only. Are you okay? Now, so I am showing this this question only because of your understanding. As per your knowledge, what is the CAPM formula? RF plus beta into RM minus RF. So let us decode that formula. There is RM minus RF is there na. Can I use a word called market premium? RM minus RF is there na after beta. Can I use the word market premium? Why the word is premium? Sir, beta is a risk to the company. Because of risk, as a owner, I need a more expectation. Yes or no, sir? As a owner, I am facing the risk. That's why what I want, more expectation or more return. That's why I'm charging premium. That is a calculation expresses beta into RM minus RF. Hope you guys understand the concept of the formula. Okay, done. Let us check this box format. What are the information they given? They provided risk-free rate. Can I use the word RF? Okay. Equity risk premium. RM minus. Okay, happy. Beta. That is nothing but sensitivity or index. Okay. What about the small stock premium? What about the small stock premium? We are facing that word first time, I think. Next, company specific risk premium. Company specific risk premium. Same, we are facing first time. Yes or no, sir? As of now, we know only 3: RF, beta, RM. This under note point is RM minus RF called market risk premium. As per CAPM, we know only this and their full forms. RF means risk-free rate of return. RM means market rate of return. Beta means risk or sensitivity. Guys, clear? Now, what this new words is given? Okay, done. Industry risk premium. No, it's a first term. When it comes to pre-tax cost of debt, can I use the word I? What you want, I or KD? What you want for calculation? KD or I? KD is different, I is different. What the percentage they given in the debenture, that is called I, interest percentage. But I want KD. What is the difference, sir? Sir, I is nothing but pre-tax, sir. If you multiply with the 1 minus tax, you will get a post-tax, that is called KD. Guys, clear? So it's a pre-tax or post-tax? They specified. What is the specification they given? It is a pre-tax. Even they're not specified, we can use the word, we are taking assumption what? Pre-tax only. Okay. You can observe the last column of the box. If you use the 1 minus tax, then only it converted into KD. Okay. That information I know. Next, debt divided by total capital for the public firm in industry. Debt divided by total firm in the industry. Simple. Total capital for a public firm in industry. If I procure 1 rupee from the market with help of all sources, on that 1 rupee, the debt portion is 30%. Hope you understand. So can I take 0.3 divided by 1? What's the mean for 0.3 divided by 1? If you take 1 rupee as all sources, out of 1 rupee, 0.3 is a debt. Guys, clear? Okay, done. Next, another word is given, optimal debt, current debt. Optimal debt divided by total capital. What are the amount they take in? 1 rupee. Out of that 1 rupee, what is the optimal debt percentage? 12%. Okay, done. Current debt point of view. If I procure 1 rupee, the current debt portion is 3%. Tax rate 30%. Now see the KCA, what they're expecting from us. Calculate the required return on equity using the, what is the requirement? RF, beta, RM. Yes or no, sir? Yeah, I already have. But I have a lot of doubts in this question. The new premiums is given. New premiums are given. That's I have a doubt. Next, expanded CAPM. What is the second question? KE as per CAPM. KE as per expanded CAPM. What about the third question? And the build up method. So it means CAPM can be calculated in 3 ways. One is basic version, what you knows, RF plus beta into RM minus RF. Another one is expanded CAPM. Another one is build up CAPM. Guys, clear? So in a previous class we discussed only one thing, that is called basic CAPM. In all subjects we are using that basic only. But the new concepts are involved here. What are the new concepts? Expanded CAPM as well as now check with the point number 2, you will get a clarity. A small stock premium and company specific risk premium are determined because a private firm is much smaller and much less diversified than the public firms that beta is estimated from. Now understand clearly. We have 2 types of companies in the market. One is public companies. Another side, private companies, small cap companies, startups. Guys, clear? Now when it comes to public company, available of information is fully there. Yes or no, sir? So it talks about theoretical in the nature. They are focusing only on how much premium I want because of market risk. How much premium I want because of market risk. I am facing a market risk. That's why I want more premium. That is called RM minus RF. Completed. Now when it comes to private companies, startups, and small cap companies, here they are following a practical approach. Our expectation not because of market, because of lot of things. Our expectation can be changed. Because of small stock premium. Because of what, sir? Small stock premium. Because of company specific risk premium. So the point you have to understand, in public sector companies, there are taking assumption our expectation change only because of market risk. But when it comes to private company point of view, startups and small cap companies, they are following a practical approach. My expectation not change because of only market risk. There is some other risk also there. What is the some other risk? What the list they given is a some other risk. Are you clear? Now when it comes to expanded CAPM, you have to consider market risk expectation plus other expectations. Next, there is a concept name called build up method, right? In this build up method is maximum used for private companies and startups. Why? Because they don't know about the beta. So if there is a no beta, I can't calculate KE under CAPM. Even though there is a no beta, you can calculate that expressed by build up model. Are you clear, sir? So what they consider means they will consider all premiums. KE equals to what, sir? All premiums. So in a build up method, KE we can easily find out 3.6 plus 6 plus 3 plus 2 plus 1. What I told, sir, instead of beta we are considering all premiums. How many premiums you have here? 3.6 is there. RF equity risk premium is there 6%. That is nothing but market risk premium. Next, Small stock premium is there 3%, and company specific risk premium is there 2%, industry risk premium is there 1%. What's the total? 15.6%. Here I am not using the calculation of beta RF plus beta into RM minus RF. I am not used. What I used here, I consider all premiums. Now let us check the answer. See, the using build up method, beta is omitted. Beta is what, sir? Omitted. So but the industry risk premium is added to the risk free rate, equity risk premium, small stock premium, and company specific risk premium. This is a very new point and a new concept introduced in our workbook. It's not there in our board book. Hope you guys you understand. Huh? Now see. Now when it comes to CAPM, we are calculating in two ways based on the company nature. Public companies. What is the second classification of companies? Private companies. Small cap and startups. When it comes to public companies point of view, we are using what? Basic formula. What is the basic formula, guys? Equity shareholder expectation equals, what is the meaning of KE? Required return of equity shareholder. KE, required return of equity shareholder. Minimum rate of the equity shareholder. Expectation of the equity shareholder. Yes. Expectation of the equity shareholder equals to RF plus beta into RM minus RF. So when it comes to private companies and small cap and startups point of view, we are not using basic calculation. We are using what? Expanded CAPM. And next, build up CAPM. The basic CAPM assumes that all investors face only market risk. And they are fully diversified. So we use the expanded CAPM to make the KE, that is nothing but cost of equity, more realistic by adding relevant risk premiums. Highlight the word relevant risk premiums. Now under expanded CAPM, KE equals to RF plus beta RM minus RF plus CRP plus SP plus LP, so on. CRP equals to country risk premium, SP represent size premium, LP represent liquidity premium. So simple example, sir. I'm doing business in US. I'm doing a business in US. I am following basic CAPM. So on that US based company, they expect only risk related to the US market. Now they are expanding their business to India. Now here that company have a Indian shareholders. Now Indian shareholders are only expecting market risk of US or both of the India and US. Both of the India and US. That is nothing but country specific premium. Guys, clear? First you can observe here is there na, that is called USA company premium expectation because of risk. Here is there na, because of Indian investor involving on that company, he having a two risk. What are the two risk? US market risk, Indian market risk. That's why automatically he will expect more or expect less. Expect more. That's called adding. Are you clear? Same when it comes to size premium. If size changes, risk increases to the shareholder. Automatically he will expect more than the what he having from the basic. That's why I'm added. Are you clear? Next, when it comes to liquidity premium, when it comes to liquidity premium, volatility or conversion. Because of conversion also, company have a facing a risk. If company facing a risk means it impacted by whom? Shareholder. That's why he will expect more. Are you clear? That is called relevant risk premiums. You need to consider as your market as well as relevant. But what happening in basic? They consider only market. Guys, clear? Done. Sir, liquidity risk due to volatility, change, conversion, money related way. Okay. Now, when it comes to build up CAPM, Now, simple logic, man. Private companies, small cap companies, startups don't have a beta value. Why? Because they're newly started. But public company already existing. That's why they have a beta in the market. So if there is a no beta, we are using what, sir? Build up CAPM. The build-up method is a variant of CAPM used to estimate the KE, especially when beta is unavailable or are unreliable. Unavailable or are unreliable. When we are using build up CAPM for KE calculation, if there is a no beta, if there is a beta is not relevant for my startup company. Okay. Now how I calculate, sir? When it comes to the calculation, KE equals to RF plus equity risk premium plus size premium plus plus specific risk premium plus country risk premium. In simple, you can use the word sum of all premiums is known as KE and build up model. Guys, clear? Now simple, another point you have to understand here, just like a note point. See, note beta adjust risk in basic, okay, basic CAPM. So how can I adjust the risk, sir? In basic, how can I adjust the risk? With help of beta, but no adjust risk in build up CAPM. So here we are not adjusting any risk, sir. We are directly taking premium of expectation. Why? Because we don't know the risk. Guys, clear? No, so once again I'm explaining. See here. So this is my expectation, guys. Minimum I want if I invest in the government security. Minimum, that is requirement. After that, company is saying that in our company we have a what? Risk. If your company have a risk, I want more than the more premium, more expectation. That's why I'm calculating equity premium with the help of RM minus RF. Are you clear? Here you affected by only one thing, that is called market risk. Are you clear? It's just a theoretical in the nature. But you can observe this expanded CAPM and build up CAPM. It is a there is a practical approach. It's a practical approach. So in a practical, your expectation affected by lot of things. Specific risk, market, country risk. Are you clear? Next, when it comes to industry risk, all will impact. You are not considering under basic. Please consider now. Are you clear? If risk increases, automatically what about your expectation? increases. Guys, clear? You are expecting premium or discount? Premium. That's why we are adding all premiums. Very clear? Now, read the points, sir. I hope you will get a clarity. An analyst is examining private firm. What firm, sir, it is? If private firm, if you have available information, you can use the word, you can use calculation of basic. If it is information is not available, either you can use what? Expanded CAPM or build up. Are you clear? Now, what is the first point? The current capital structure is non-optimal because the owner avoids the use of debt. Forget that sentence. I will give in a clarity on the capital structure. Now, what about the point 2? A small stock premium and company specific risk premium are determined because the private firm is much. What does it mean for small? Small capital. Small capital. Much less diversified. If it's a fully diversified, you can read the point. What I written here. Fully diversified. What you have to use? Basic CAPM. If you are not fully diversified, second point. Guys, clear? Done. The industry risk premium reflects the additional risk the industry compared to the broad market. Here, this industry risk premium we are using in a build up model. Okay. Now, I think we can easily answer. So you can observe direct. I will go with the presentation. Let us check in which problem in our material. So our practical book 5 is ready. Wait, I will share. Follow the updated book, guys. Go and check your Telegram channels. What's the illustration number? Illustration number 5. So wait a moment. I hope you understand the concept of CAPM. Okay. Now the basic version of calculation is there called KO calculation. KO. It's a simple concept. Why? Because the previous problem is related to KO. Here also they will ask KO. You can observe, check the second question. What is the requirement of second question? Calculate the weighted average cost of capital using the current capital structure and optimal capital structure. You can go and check points in a table. They provided two types of capital structures. Optimal divided by total capital, current divided by. Are you clear, sir? So it means what? They want KO in two bases. Okay. Before that, learn the KO calculation. Now see, important concept. Overall cost of capital or weighted average cost of capital. Weighted average cost of capital, it's denoted with KO, guys. It is denoted with KO. It is denoted with KO. So I think you learned in a box format. Sources, book value or market value, specific cost of capital, weights. You will get a product. Sum of product is known as KO. So let us understand in a concept point of view. So how much you procured from the market as per example 100 CR, right? Everyone had a expectation. Now for example, equity shareholder had an expectation of 12%. Equity share expectation of 12%. Who's R? R. Returned earnings. Whom fund it is? Shareholders fund. Automatically they will expect same as equity share capital. That's why here also 12%. Can I use the word K equal to KR? Why? Because two are same one. Two funds owners are same. Equity shareholder. Now cost of debenture is there. KD. They're expecting 10%. Preference shareholders is there. They're also expecting. They're expecting 11%. Bank is there na. Bank or term loan. Now KT. For example, 9%. Now what is the sum? What's the sum? Sir, in YouTube, students also need to respond, sir. Please tell me your answers in chat box, live chat. Please participate. So how much? 54%. What's the mean for 54%, guys? I procured 100 crore rupees day one. At the end of the year, I need to repay how much, sir? As a capital repayment or only interest or expectation? As it possible? Is it practically possible? It means if you procure 100 crore rupees, you are just paying 50 crore rupees. Just go with a basic example. I take a loan, bank loan, 100 crore rupees. At the end of the first year, I am repaying how much, sir? 54 crore rupees. What does it mean for 50 crore? As an interest part, not a capital repayment. Practically possible. Practically possible. That's why we are not using word called overall cost weighted. We are not using a word called cost of capital. It is. Are you clear, sir? So what is the real cost of capital? If you consider weights, then you will get a overall cost of capital. That is a purpose they're using a word called weighted average cost of capital. This is not a cost of capital calculation, guys. Okay, I got in a practical manner. Now see, KO, overall summation or weighted summation? Overall summation or weighted summation? Weighted summation. Weighted summation of all specific cost of capital. Weighted summation of all specific cost of capital. Yeah, Shamir, good afternoon. Now when it comes to the calculation part, listen carefully. KO equals to cost of equity plus weight of cost of equity into weight of equity plus cost of retained earnings into weight of retained earnings plus cost of preference into weight of preference plus cost of debenture into weight of debenture plus cost of term loan into weight of term loan. Guys, clear? Now, sir, we know, sir, how to calculate KE. Either based on earning point of view or a dividend point of view or a CAPM. Yes or no? No. So we already learned in above session. But when it comes to how to calculate weight of equity, now weight of equity equals to amount of equity share capital divided by capital employed. Amount of equity share capital divided by capital employed. Amount of equity share capital divided by capital employed. How much you procured, sir, as per example? How much totally? Total 100 crore rupees. That 100 crore rupees is known as capital employed. Capital employed. Guys, clear? Out of 100 crore rupees, how much is the equity share capital? 20 divided by 100, 0.2 is the weight. Guys, clear? Done? Now, weight of retained earnings. How to calculate weight of retained earnings? Same. Amount of retained earnings divided by total capital or capital employed. Out of 100 crore rupees, you have procured 20 crore as a return on retained earnings. How much weight it is? In percentage point of view, 20%. In weight point of view, 0.2. Guys, clear? Huh? Now, retained earnings divided by capital employed. Next, weight of preference. How you get a weight of preference? Amount of preference share capital divided by capital employed. 20 crore divided by 100 crore. 0.2 is a preference weight. Simple manner, if I procure 1 rupee, on that 1 rupee, 0.2 paisa is a equity, 0.2 paisa is a 0.2 paisa is a. If values are changes, proportions also change. In this example, all proportions are same, but when it comes to the reality, proportions will be changed. Very clear? Instead of 20, if I procure 30 CR as an equity, what is the proportion? 30 divided by 100, 0.3. If I procure 90 CR only from equity, what is the equity proportion? 0.9. In rate point of view, in percentage point of view, 90%. That's called weights. Okay. Now, how to calculate weight of preference? Amount of preference share capital divided by capital employed. Now, how to calculate weight of debenture? Debenture amount, debenture capital amount divided by capital employed. Now, weight of term loan or bank loan divided by capital employed. I hope you understand how to calculate KO. Okay. So, the important thing here, you are summing all specific cost of capital or weighted specific cost of capital. Weighted specific cost of capital. Sir, clear, sir? Okay, done. Now, let's check illustration number 4. Illustration number 4. Illustration number 4. Suppose Alpha Limited as a capital structure composed of following: debt 30 million, equity 45 million. If the before tax rate of return on equity is 16.5% and the marginal tax rate is 30%, what is Alpha Limited's weighted average cost of capital? Sir, what you said, sir? There is a equity share capital, retained earnings, etc., etc. 5 sources now. But in this question, they provided only 2 sources. What are the 2 sources? Equity 45 million, debt 70 million. What is the capital employed? What is the capital employed? 75. Debt plus equity. Total individual capital sum is known as capital employed. Now, what is which kind of capitals we have? Equity, debt. Are you clear? In simple, sir, I am not recording this problem in notes, sir. The basic problem. Now see, KO. Generally, we have a big formula, but based on information only, we will conclude. Now, cost of equity into weight of equity plus cost of debt into weight of debt. That is a sufficient formula for this problem. Are you clear now? Now, cost of equity given in the question directly. The required return of on what? Equity is what? 16.5%. So 0.165. How to calculate weight of equity? Amount of equity share capital divided by capital employed. So amount of equity share capital 45 divided by 75 plus KD 11% or 11% into 1 minus tax. 11% or 11% into 1 minus tax. They specified here what? Pre-tax. Even though they are not specified, we are assuming it is a pre-tax only. Unless they specify it is a post-tax. Guys, clear? Now, So can I take 0.11 or 0.70, 0.07? I think 7.7% is the answer. 0.077. Yes or no, sir? Let's check the calculator. KD equal to 0.11 into 1 minus tax. That is nothing. Can I take 0.7? 1 minus tax. 0.7 into weight of debt. How you get a weight of debt? 30 divided by 75. Now please tell me the calculation part. 45 divided by 75 into 0.165. 45 divided by 75 into 0.165. Just tell me that value. 0.099. This 0.099 is known as 0.099 is known as weight of equity equity capital. It is not a individual. It is the weight of equity cost of capital plus 0.11 into 0.7 into 30 divided by 75. 0.0308. Guys, clear? Now the 7.7% is there na. It is called individual. This 0.0380 is there na. It's called weighted debt capital, cost of capital. Now what is the sum of these two? 0.1298. If you multiply with the 100, you will get 12.98%. Maximum of the calculation go with the rate. You will get a simple calculation instead of percentages. Then final answer you can convert it into a percentage. Guys, clear? Now see, KE equals to 16.5%. KD equals to 7.7%. Now what is the total of 16.5 and 7 plus 7.7? 24.2%. Now what is our answer? Now which one is a KO or cost of capital or overall cost of capital? 24.2 or 12.98? Guys, clear? So this is called individual summation. This is called what summation? Weighted summation. Simply sense, which one is practically possible? Repayment of cost as a 24.2 per year or a 12.98? 12.98. Clear na? Next, open your new material. Now illustration number what, sir? As per our new material. Illustration I sent it in Telegram. Next problem 5. Now I will record in this our notes. What's the problem number? Problem number 5. What about the case A? Headings are very, very important. You are not a inter-level student, you are a final level student. You have to specify what you are doing. Guys, clear? Now case A. Estimation of cost of equity under basic CAPM, expand CAPM and build up CAPM model. Now see, on that first one, basic KE equals to RF plus beta into RM minus RF. Sir, you need to write full forms. It's a very important thing in final stance. Okay. Now at the side, write down like this. RF means risk-free rate of return. You can go with the full form. How much percentage it is? Can I take a rate? 0.036. 0.036. Next, I want beta. Risk sensitivity. Risk sensitivity. 1.3. 1.3 times. RM is there, or directly RM minus RF is there? RM minus RF is there. RM minus RF equals to equity risk premium or market risk premium or market equity risk premium. Guys, clear? It's just alternative name. Equity risk premium. How much, guys? 0.06. Now substitute in the equation, you will get an answer. 0.036 plus 1.3, 0.06. Answer 0.1.4. 0.114. 114. Can I use it as 11.4%? Are you clear? As per theoretical, it is 11.4%. But there needs to be the practical exposure. That's why I am doing a expand. Next, expand CAPM. Now, what's the formula for expand CAPM? So you can take directly basic KE. Can I take directly basic KE? That's one is the RF plus beta into RM minus RF, right? Plus, don't use a shortcut, go with the full form here itself. What is the next one? Country specific risk. Sir, you can observe in this expand CAPM, there is a no industry point. You need to keep that point in your mind. Only other elements affecting our company only we will consider. We are considering. Now, country specific risk plus size risk plus liquidity risk. Now, basic KE I already calculated. How much? 0.114. 0.114 plus any country specific risk in the question? 0.02. Any size risk is there? Size risk. Yeah, that's a small stock premium is nothing but size. The word small represent what, guys? Size. Large and small. It talks about which nature? Size nature. Clear? If you want that clarity, in a brackets, write it down. So in a size risk, use the word bracket, small stock premium. How much is small stock premium? 0.03. Next, liquidity risk is there? No. So if there is no liquidity, go with the 0. That's it. If they specify only, we can consider. Now what is the answer? 0.164. Can I take it as 16.4%? 16.4%. As per expand CAPM, what is a KE? 16.4. 16.4. Now, which one is appropriate for decision for private company? Basic or this expand CAPM? Expand CAPM. Why? Because I consider country specific, I consider size Size specific, size risk, I consider liquidity risk, I consider market risk, I consider all risk for calculation of expectation. But in basic, they consider only market risk. Okay. Now, there is another calculation part. What is another calculation part? Build up. Now, KE equals to can I take basic KE? Can I take basic KE? No, sir. Inside, write it down. No beta. If there is a no beta, how to calculate? You can observe the solution also. They used a word called omitted. Guys, clear? Instead of omitted, I used a word called no beta. Okay. So, can I take sum of all risk in the market or industry? That's the point is important. Sir, understand the sentence. Here KE means sum of all risk in the market or all risk in the industry. Market and industry. Market and industry. Not market, not industry. Both consider as a KE calculation. Now see, sum of all risk in what and what, sir? Market and industry. At this point in theory also, sum of all risk in market and industry. New concept, no? Yes or no, sir? Now please tell me the list what you have. RF is there, plus equity risk premium is there, plus small stock. Can I use the word size premium? Size risk premium is there, plus company specific risk premium is there, plus industry risk premium is there. Guys, clear? Or you understand what is the difference between market and industry? Yes or no, sir? Now please tell me the RF answer. Zero point 0.036 plus 0.06 plus 0.03 plus 0.02, 0.01. Now the answer. $0.156 or 15.6%. So if you face this kind of questions first time, automatically you will feel it's a risky. Why? Because so many risk words is given in the question. So if you understand the concept of expand and this build up, we can easily answer this kind of questions. Are you clear? Now today onwards, CAPM means you need to maintain a full picture of basic, expand. Guys, clear? Okay. Now case A completed up to now. What about the case B? Case B. You can use the word estimation, calculation, that kind of words you can use, no issue. But here estimation is not appropriate. You can I am using a word called calculation. Calculation of weighted average cost of capital Under two scenarios is given. Under current and optimal. Current and optimal capital structure. Sir? Structure. I use a word called structure. You will get a clarity at time of capital structure chapter. Up to now, just focus on the what I told. So just capitals, cost of capital under current and optimum capital structure. Now the first point, current capital structure. Now KO equals to, I already said, sum of 5 weights cost of capitals. But you can observe the question. I understand only two things. One is equity share capital, another is debt. Sir, how you decide, sir? You can observe 30% is a debt. What about the 70% of the 100 rupees? Equity. Are you clear, sir? So generally we have a 5 sources, but maximum of the standard problems they are using only 2 sources, that is called equity and debt. Equity and debt. Are you clear? Now KO equals to cost of equity into weight of equity plus cost of debt into weight of debt. Now I think K is specified in the question. Don't take case 1 K is, consider what I expressed. What I expressed as per question. 16%. Guys, clear? Sir, if case B K is silent, I have a 3 K is na. If K is not there in the case B, which K is suitable? Which K is suitable? That's why they provided company name. Which company it is? Private company. If there is a beta, there is a no beta. 2 types is there. If there is a no beta, build up. If there is a beta, now basic, expand, build up. Which one is appropriate? Expand. Beta is there, na? Clear, sir? It's not an assumption, it's a common sense. Clear? Done. Now K is directly given 0.16. How to calculate weight of equity? How to calculate weight of equity? Listen carefully. Weight of debt is given in the question. Where, sir? Go and check the current debt divided by total capital. Current debt divided by total capital equals to how much? 0.03. Out of 1 rupee, 0.03. We have only 2 capitals based on the question, equity and debt. No. Current 3 ratios is there. Industry is there, current is there, optimal is there. What is the heading? Optimal capital structure. Don't confuse. If I consider on industry basis, I will took that 30%. But I am doing a calculation under where? Current capital structure. Guys, clear? Now see, if it is a 0.03, 3% only now, that is the weight of debt. What about the weight of equity? If only 2 capitals is there, out of 1 rupee, 0.03 debt means what about the pending portion? Equity. Now weight of equity equals to 1 minus 0.03, that is nothing but 0.97. The total 1 rupee completed. Guys, clear? Now what is the weight of equity, guys? 0.97 plus cost of debt given in the question paper. Yeah, given post pre-tax rate is there. How much? 9%. Can I take that 9% or 1 minus tax? So 0.09. What is that? 1 minus tax? 0.7. 1 minus tax. Yeah, tax if you remove what? 0.7 into weight of debt. I already calculated. They given 0.03. Now please tell me the answer. 0.16 into 0.97. 0. 0.1550. Direct answer. Only for equity, weight of cost of equity. 0.1555. 1552. Plus, what about the weight of cost of debt? What more? 0.189. Now what is the summation? 0.0. Okay, ma'am, here you need to take 0.03. I think you've taken 0.3, I think. No, it's a 0.03. Now what is the 0.00189? Now what is the answer? 0.157. Can I take 15.7%? Yes, that's simple. It is. Problem is not completed. Another point is there. What? Optimal capital structure. Now KO equals to same formula. KE into weight of equity plus KD into weight of debt. So I already wrote one time. Then I can take directly, no issue, sir, in exam point of view. Either full form or formula, if you write one time, that is enough. If it is the second time is came, you can directly use a calculation. Now KO equals to same 1.16 equity, no change. Next, I think weights are changes. Now see, weight of debenture or debt equals to optimal debt divided by total capital. What is the answer? Optimal debt divided by total capital. Specified in the question paper. 0.0.12. So only two capitals is there. If out of 1 rupee 0.12 paise debt means, what about the pending? What about the pending? Equity, how much? 0.88. Completed 1 rupee. Now see, weight of equity equal to 0.88 plus KD 0.09 into 0.7, 1 minus tax, into weight of debt 0.12. Now please tell me the direct answer. Total 14.8283. KC is there, I think. Comment on the appropriate capital structure weights. So if you want to write this answer, you need to understand a concept name called capital structure. After completion of the capital structure, we will come back and I will give a clarity about the what is current, what is optimal, what is non-optimal, what is this capital structure appropriate. I will give a clarity. Okay, done. So up to now, cost of capital is completed. Guys, clear? So what is ultimate agenda of KO? Clear? On that KO, the important thing is CAPM. Remaining all are similar. Okay, done. Our next topic concept number 2. Sir? Yeah. Okay. Realized deal. That's a basic stuff. Just for it's there in intermediate. That's why I told. At final level is not that much of required. Okay. Okay, guys. When it come to realized deal is there, na? Yeah. Sir, if I put a 1 rupee on share market, I have two expectations. One is capital appreciation, another one is dividend. Very clear? When I are calculating cost or expectation, always I am taking a benefit on numerator, investor point of view. Cost as a numerator, company point of view. But interest is there. Investor point of view, interest is there, received income. Company point of view, expense called cost when it comes to terminology. Now, how you calculate basic stuff? Interest divided by amount invested. Yes or no, sir? That interest invested divided by amount. Now, the point is, when it comes to the realized yield, KE equals to D1 plus P1 minus P0 divided by P0. It's not there in your final level, it's intermediate concept, realized yield. There is advanced concepts is there based on realized yield in chapter name called valuation of assets and liabilities. Up to that, just understand this only. That is sufficient. If I put a 1 rupee of investment, I expect two things. One is dividend, another one is capital appreciation. Sir, what is the mean for P1 minus P0? Means I invested 100 rupees. Now today it is a 120 rupees. If I sold, how much I will receive? 120. Out of 120, how much benefit I have? Can I use the word capital appreciation? How we get that 120? 20 rupees. 120 minus 100. That is nothing but P1 minus P0. Very clear? You see, they announced 2 rupees of dividend. They announced 2 rupees of dividend. Now, amount of investment equal to how much? 100 rupees P0. 22 divided by 100 into 100, 22%. You can observe the numerator. D1 is a benefit as well as capital appreciation is additional benefit. That's called realized yield. That is okay. Next, concept number 2. Capital structure. Capital structure. So this is our existing company. This is our existing company. Equity share capital equals to 100 crore rupees. Equity share capital equals to 100 crore rupees. Guys, clear? Now, company required another 50 crore rupees. Company require another 50 crore rupees. So management of this company is there now. For example, name of this company is Shikara. Okay. The management of this Shikara company said to their CEO and not CEO, CFO. So company take a decision. We need a 50 crore rupees. You are the CEOs. Are you clear? In market, there is a lot of sources is there. If I, as a CEO, you as a CFO, if I ask a question, how you procure this 50 crore rupees? What's your answer? Tell me in detailing. How much is the equity? How much is the debt? How? That kind of explanation I want. As per your mindset, I want 50 crore for our company. How you procure? I want in numericals. And where we procure? Tell me. Option 1. First option, second option, third option, fourth option. First option. How you? So equity point of view, 50%. Can I take 25 CR? Debt, another 25 CR. Okay, done. Option 2. Same. Total 50 equity. Equity, total equity 50 CR. Debt nil. What about you? 100% debt. Oh, nice. Option 3. Equity nil. Debt 50 crore rupees. So these are the alternatives we have. The question is, out of these 3 options, which one is the best one? Out of these 3 options, which one is the best one suitable to the Shikra company? That is the question. This point of view, option 1 is correct. That by point of view, option 2 is correct. That point of view, option 3 is correct. Now, which one is the best? I don't want correct answer. I want best answer. Sir? Okay, let us check what are the things happening in the options. For example, if you pick option 3 is the best one. If you think option 3 is the best one, because of this 50 crores only because of debt, it is a risk to the existing owners. It is a risk to the whom? Existing owners. Yes or no, sir? If risk came into the company, they are leave, they are continue. As a owner, are you continue or are you leave? Leave. So if you want to continue, you will ask extra expectation. Yes or no, sir? That's why option 3 is not a best option because of risk is there. Are you okay now? Now when it comes to option 2, because of 50 crores of equity, new shareholders are increases. New shareholders are increases. If new shareholders are increases, your ownership what happen? Increase or decrease? Can I use the word ownership dilution? As a owner, are you ready to dilute your ownership? Yes or no, sir? That's why this also be not a best option. Okay. When it come to option 1, 50% equity, 50% debt. Because of equity, new owners are came. Because of debt, risk is came. Are you clear, sir? It impacts whom? Existing shareholder. There is a no issue for new shareholder. There is a no issue for whom? Debenture holder. There is a issue for whom? Existing equity shareholder. That's why this also be not a best. Are you clear, sir? So capital structure means it is a systematic composition of long-term funds. What's the mean for capital structure? Systematic composition. In a simple manner, ఇలా పడితే అలా క్యాపిటల్ తీసుకురాకూడదు. దాని నుంచి తీసుకొని వస్తే నాకు బెనిఫిట్స్ ఎక్కువ ఉండాలి, కాస్ట్లు తక్కువ ఉండాలి. అప్పుడే దాన్ని నేను ఆప్టిమమ్ క్యాపిటల్ స్ట్రక్చర్ అంటాను. Hope you guys understand meaning of optimal capital structure. What's your optimal? So don't take these proportions based on your knowledge. You need to consider these proportions based on company's best manner, company's point of view, which one is the best. That's a word called optimal capital structure. Optimal capital structure. Now, this already existing is there now 100 crore. This is called current capital structure. Current capital structure. Now, if you pick option 1, for example, if you pick option 1, what happened? Your structure change or same? Previously, my structure is 100% equity. Now it is equity plus debt because of option 1. Guys, clear? This is called current structure. This is called a new structure. Are you clear? Now, on that question, they're not used the word called new structure. They used a word called optimal. You know what is the mean for optimal? The best mix. The best mix. Okay. Now see. If you procure any additional fund with help of different sources, the risk will be more or less. Risk will be more or less. If you procure any money from the outsiders, company point of view, are you ready to bear more risk or less risk? Less risk. It means if you procure the money, the risk must be low. Are you clear, sir? Out of these 3 options, for example, I am focusing only on risk point of view. Out of these 3 options, where you have a risk low, that is the best. I am not focusing any other things. I am focusing only on risk point of view. Out of risk point of view, I think option 2 is the best one. Option 2 is the best one. Now I can use a word called option 2 is a optimal capital structure. Optimal capital structure. Now, forget about the risk. There is a new element came into the picture. KO. What's your KO? What's the mean for KO? Weighted average cost of capital. As a company, do you want more cost of capital or less cost of capital? I'm not focusing on the risk, etc. I just focusing on KO. For example, KO, if you pick this option, 14%. If you pick this option, 13%. If you pick this option, 10.5%. Now, where your KO is low? Option 3. Are you focusing risk or KO? Just KO. Forget about the risk. Now, out of these 2 options, which one is the optimal capital structure? Option 3. Based on this only, we will decide which one is the optimal. Guys, clear? Now, KO, minimum or maximum? KO must be minimum. Okay, done? What's the full form for MPS? Market price per share. Market price of a share. Okay, done. Now, if you procure money from a market, do you expect more MPS or less MPS? MPS. What we want is need more. What we don't want is a less or minimum. Clear? MPS is required or not? Yes, that's why you expect what? More MPS. What's that? More. Can I take here maximum? Can I take here maximum? Very clear. Now the point is, I'm not focusing on the risk. I'm not focusing on the KO. I'm just focusing on the MPS. Now I calculated MPS for option 1, 24 rupees. Option 2, 23 rupees, 27 rupees. Option 3, 30 rupees. Out of this, where is the maximum? Option 3. Can I use the word optimal capital structure? Based on what? Yes. Forget about the all. Are you clear now? Done. Next. EPS. Do you want more EPS or less EPS? As a one, more EPS or less EPS? More. Can I take maximum? Out of these 3 options, you need to calculate EPS of option 1, EPS of option 2, EPS of option 3. Where you will get a more EPS, that is your best or optimal capital structure. If you are focusing on one thing, forget about the remaining all. Are you clear now? Now all points covered, one point is missed. Ownership. Are you ready to dilute or not ready to dilute? Not. Yes or no, sir? Which option is not diluting your ownership? That is your best or optimal capital structure out of the three options. Forget about the remaining all calculations. Just to focus on the ownership point of view. Not dilute. Sir, clear, sir? So these are the conditions for optimal capital structure. I hope you understand what is the mean for current structure, optimal capital structure. Are you clear? Optimal capital structure. When it comes to capital structure means systematic composition of long term funds. Systematic composition. Systematic composition. అర్థమైందా? సిస్టమేటిక్ అంటే నచ్చినట్టు చేయకూడదు, ఆప్టిమల్ చూసుకోవాలి. ఓకే, క్లియర్? సో ఈ ఆప్టిమల్ క్యాపిటల్ స్ట్రక్చర్ని ప్రూవ్ చేయడానికి మనకి ఇది జస్ట్ అండర్స్టాండింగ్ పర్పస్ కోసం రాసింది. ఇవన్నీ కన్సిడర్ చేస్తూ మనం క్యాలిక్యులేషన్ పార్ట్ చేయాలి. ఈ ఆప్టిమల్ సో వీ హ్యావ్ టు కన్సిడర్ దిస్ ఆల్ పాయింట్స్. ద ఆప్టిమల్ క్యాపిటల్ స్ట్రక్చర్ ప్రూఫ్ ఈస్ దేర్. వెన్ ఇట్ కమ్ టు optimal capital structure proof, we have approaches and analysis. Approaches and analysis. So first we talk about the analysis. When it comes to analysis, EBIT to EPS analysis, EBIT to MPS analysis, indifference point analysis, financial break-even point. Financial break-even point. Guys, completed? So I already said now, when it come to, if you are focusing on MPS, you need to pick highest MPS. If you are focusing on EPS, you need to pick highest EPS as an optimal capital structure. The calculation part is involved in this EBIT to EPS analysis, EBIT to MPS analysis. There is no problem based on this in your final. So there is a lot of problems in interstage. Guys, clear? But the analysis we are used for the proofing of what? Optimal capital structure. Optimal capital structure. Now when it comes to approaches, so based on these approaches we have a multiple problems in our material in final point of view. Relevance approaches, Irrelevance approaches. Relevance approaches, irrelevance approaches. Now understand the word of relevance approach. Market value of a firm change if capital structure changes. Market value of a firm change if capital structure changes. What's the mean for capital structure change, sir? What's the mean for capital structure change? Sir, previously my company following a 100% capital structure. Can I use the word current capital structure? If I pick any of the option 1 or option 3, my capital structure will be changed. What's the change? Previously it is a 100% equity. Now it is a equity plus debt. If my capital structure change from equity to equity plus debt, automatically my market value also change. Guys, clear? That's concept set by relevance approaches. Now my point is, your market value depends on the structure, or structure is dependent upon the market value. Market value depends on the structure, or structure depends on the market value. Market value depends on the structure. It's called relevance approaches. Relevance approaches. Now when it comes to irrelevance, name itself saying that opposite to the relevance. What is the opposite to the relevance? Market value of firm not change if capital structure changes. Market value of a firm not change if capital structure changes. You can change from 100% equity to 100% debt. You can change from 100% equity to 50-50. You can change from 100% equity to 30-40, 30-70. You can change 100% equity to 70-30. You can change, but market value remains constant. That's said by irrelevance approaches. Irrelevance. What about the relevance? If capital structure changes from 100% to any percentage of mix, automatically your capital structure, market value also change. I am not saying about the increase or decrease. If it changes, it also be impacted, either increasing impact or decreasing impact. First thing, it will be impacted, guys. Okay. Now for proving this sentence, we have two concepts: net income approach, traditional approach. For proving this market value constant, we have another two for proving this irrelevance approaches, we have another two concepts name called net operating income approach Modigilani Miller approach, shortly MM. I hope, are you getting these concepts? Do you know this? Okay. So this also one type of valuation we done in inter-level. Are you clear, sir? Market value of firm is nothing but company value. Market value firm is nothing but company value. So our valuation definition also said value of a company, asset or security. Are you clear? Okay. That's why they linked that inter topics in final stage. Nothing is new. Okay. So I am not explaining about the detailing of the approaches. I just explain the why we are using NI, why we are using NOI. There is a shortcuts. Net income approach, net operating income approach. This all. Okay, done. Now first we start with the net income approach. Net income approach. So this net income approach explanation given by David Doran. David Doran. It's a practical example also, sir. This net income approach followed by a lot of people is there in India. The first person is Vijay Mallya. The first person is Vijay Mallya. The second person Nirav Modi. This all people follow this net income approach only. Sir, okay, sir. What this net income approach expresses? The net income approach expresses cost of debt is cheaper than the cost of equity. Cost of debt is cheaper than the cost of equity. Why, sir? Why, sir? Previously, I used a word. KE calculation is difficult than KD and KP as a calculation. But David Doran saying that debt is a cheaper fund in the market. Before that, we need to follow some assumption. We have only assumption number one. We have only two sources in the market. One is equity, another one is debt. Sir, cost of capital, you said 5 sources now. Cost of capital chapter. Are you clear? When it comes to capital structure, for convenience purpose, there are taken assumption. Market have only 2 sources. Generally, you can take just calculation purpose only. We consider preference share capital. In reality, there is no preference share capital. Yes or no? Na? So, is the purpose of assumption is calculation and expresses the decision. Okay, done. Only 2 sources is in the market. What are the 2 sources? Equity and debt. Another point he expresses, debt is cheaper than the equity. KD is less than the KE. Why? KD is less than the KE. Why? First point, he said, tax advantage. KE don't have a tax advantage. If your calculation is 16%, you need to pay 16%. But when it comes to KD, if it is 11%, don't pay 11%, pay just 7.7%. 1 minus tax in our example number 1. Yes or no, sir? That's why KE is always bigger number than the KD. So he expresses debt is a cheaper fund, then procure the more debt. Are you clear? Sir, what happen if I procure more debt? Sir, KD is low, na? If you procure more debt, your KO will be decrease. Your KO will be decrease. If your KO decreases, automatically your company market value increases. So I think you will not get that point. With problematic, I will express. Company already have 100 crore rupees. Company already have how much? 100 crore rupees. 100% equity capital structure they followed. What is the current capital structure? 100% equity. If it is 100% equity, means there is a existing shareholders expectation 12%. Existing shareholders expectation 12%. Clear? What about this? Current capital structure related information. 100 crores capital value is the company. 100 crore rupees taken from the owners. They are expecting 12% every year. Clear? Now, company need another 50 crore rupees for expansion. Another 50 crore rupees for expansion. Now, for company have 2 options. Option number 1, option number 2. When it come to option number 1, with help of equity, with help of debt. Only 2 options there in the market for how much? 100 crore rupees or 50 crore rupees. Forget about the current. Are you clear? Now, when it come to, if I choose option 1, what is the cost I have? What is the cost I need to pay? KD or KE? Already existingly I'm paying 12% for 100 crore rupees. Now I need to pay another 12% for 50 crore rupees. Yes or no, sir? Yes or no? The minimum common sense, what the new person came into my company, they will expect minimum what you paying to your existing equity shareholder. Yes or no? That's why here also KE is how much, sir? 12%. K is 12%. Now, if I choose option 2 debt, yes or no, I need to pay KE or KD. What David Duran said, because of tax advantage, debt is always cheaper than the equity. Can how much I need to pay? More than 12%, less than 12%? Less than 12%. Can I take it as a 10%? Are you clear? If I choose option 1, I need to pay 12% to existing shareholder, 12% to new shareholder. If I choose option 2, what are the consequences? I need to pay 12% to existing shareholder, 10% to debenture holder, not shareholder. Are you clear? Now see. If I choose option 1, 12% for existing shareholder, 12% for new shareholder. Yes or no, sir? Now totally how much I need to pay? 24%. Forget about the weights, etc. Just understand the numericals. 24%. For example, if I choose option 2, how much I need to pay at year end? 12% to existing shareholders plus just 10% to new shareholder, debenture holder. Totally how much I need to pay? 22%. Now I already said, debt is if you rises, your KO is what happen? Nana, clear Nana? Option 1 I choose the equity. Because of choosing the equity, my KO what happen? Increases. Instead of equity, if I choose debt, what happen? KO decreases. Are you okay now? That's the point they expresses. Now see the another point. Assumption. EBIT equals to 2 lakh rupees. Company earning EBIT of rupees how much, sir? 2 lakhs. What's the full form for EBIT? Earning before interest and tax, right? Yes or no? Now, market value of firm equals to EBIT divided by KO. This is the formula. I will explain after. So, yeah, market value of firm, how we find out? EBIT divided by KO. Now, please calculate as per option 1. As per option 1, market value of firm equals to EBIT how much? EBIT how much? What about the KO? 22% or 22%? 20? Option 1. 24. 0.24. Now what is the answer? 2 lakh divided by 0.24. 8 lakh 33,333. If you choose option 2, market value of firm equals to EBIT is common 2 lakhs. What about the KO? 0.22. 22% only, na? Option 2. Now my doubt, sir, previously it is 0.24. Now it is a 0.22. Why? Understand concept logically. Previously you taken 0.24. Now you are taking a 0.22. Why? Sir, option 1, even though I know equity is a costly fund, I procured equity only. That's why my KO what happened? Increased. Option 2, I followed in net income approach. On that case, they said debt is a cheaper fund. Instead of equity, instead of option 1, what I choose? Option 2. If I procured 50 crores with help of debt, how much capital I have? 100 plus 50. What is the breakdown? 100 crores for equity share capital, 50 crores for debt. For this 100 crores, I need to pay 12% as a equity expectation. For this 50 crores, 10%. Guys, clear? Now 12 plus 10, 22. KO decreases. Are you clear now? Option 1. Here also, I already have 100 crores. I am procuring 50 crores extra. How? Option 1, equity. Now total I have, or total how much I have? 150. What's the breakdown? 100 crores existing, 50 crores new equity share capital. For existing shareholders, I am paying 12%. For new shareholders, I am paying 12%. Totally how much I am paying? 24%. Are you okay now? Done. Now what is the calculation? 9 lakh 9090 090. Now where is the more market value? Option 1 or option 2? Option 2. Option 1, equity procurement. Option 2, debt procurement. Now understand the definition once again. Debt is a cheaper fund. If you rises due to low KD, your KO decreases. If your KO decreases, your market value increases. Guys, clear? So why I choose option 2? Because of debt is a cheaper than equity. If it is a low KD, my KO what happened? 24% to 22%. Decrease or increase? Decreases. Because of decreasing KO, my market value what happened? Guys, clear? Simple statement. Based on statement, it will be complete. Are you clear? Now that is a concept, guys. Just one line. Don't write this all examples. Just for understanding purpose only. Just write down that sentence. Okay. After that, we want only calculation part. Please listen. When it comes to calculation part, so I already expressed on formula. Market value of firm, it's a direct formula. EBIT divided by KO. EBIT divided by KO. Now there is an alternative formula. Market value of firm equals to market value of equity plus market value of a debt. Market value of equity plus market value of a debt. Sir, what about the preference share capital? What about the term loan, bank loan? What about the retained earnings? Assumption, we have only two sources, equity and debt. Market value of equity plus market value of a debt. So I think it's a day 3 class. In day 1 we discussed one point. I think I take a loan of rupees 1 lakh from you only, na? Every month I am paying 10,000. Are you clear? Okay, done. Just I am modifying that example. I took some X amount from you as a capital. Listen the example. I took some X amount. They don't know. You and me know some X amount. For they are asking how much you are investing in your point of view. They are asking me how much capital you procured. Your point of investment, my point of view is a capital, right? If they ask you, they are asking the investment point of view. If they are asking me, they are asking the way of capital point of view. Now they are asking a question: how much capital you have procured from Sham, right? Sham. I don't know the exact figure, but I am paying 10,000 every month as a 10%. I am paying 10,000 every month. It is a 10% rate. Can I find out the amount capital, how much they invested, or amount of rupees I am procuring? How? 10,000 divided by 10%. What you will get? 1 lakh rupee. That is nothing but market value of firm. That is nothing but market value of firm. Sir, clear, sir? Now, sir, why you taken a EBAD and why you taken a KO? Sir, as per our income statement, sales less variable cost, you will get a contribution less operating fixed cost, you will get a EBAD less interest, you will get EBT less tax, you will get EAT. Can I take it as a EAT is nothing but EAESH? Earning availability to equity shareholder. Generally, you have to reduce preference dividend from that. But as per assumption, how many capitals we have? 2. There is no preference dividend. That's why I'm not reducing any preference dividend. Are you okay? Now, there is another assumption is there. No tax is assumption. No tax is assumption. Generally, without tax, we can't do anything. Yes or no? For that, they are taken assumption, no tax. Are you okay? You don't follow that all. If the tax rate is given, consider the tax. If there is a no tax rate, it means there is a no tax rate. Are you clear? We are not following any assumptions here. Are you okay, guys? No. Sir, contribution also be known as profit. EBAD is also be known as profit. EBT is also be known as profit. EAT is also be known as profit. EAESH is also be known as profit. All are profits only. Why you are consider only EBAT instead of all? Why you are consider EBAT instead of all profits? All are profits only, na? For organization profits only, na? You need to learn alternative names. You need to learn alternative names. The contribution is also be known as variable profit. Contribution is also be known as variable profit. EBAD is also be known as operating profit or a business profit or organization profit. Operating profit or business profit or organization profit. EBT is known as taxable profit. EBT is known as taxable profit. EAT is known as net profit. In our accounts is there a net profit. EAT. EAT is known as net profit. Clear? Now tell me the answer. I am finding out organization means total or individual. Which one is the total profit? EBAT. Guys, clear? What is the EBAT in another alternative name? Organization profit or business profit? Organization profit or business profit? Clear? Okay, done. Sir, why you consider KO? Why you are consider KO? Take KE, take KD, take remaining all. Why you are considering KO? When I am finding total organization value, I want all totals. What profit I consider? Organization profit. What about the new denominator? And that also organization. What is the organization cost? KO or KE? KO. KO or KD? KO. Hope you guys you understand why that formula came. EBAT divided by KO. Clear? Done. Next, sir. If there is a no EBAT information, if there is a no KO information, you need to use this name called market value of equity plus market value of debt. Now, the market value of equity equals to EAESH divided by KE plus market value of debt equals to interest divided by KD. EAESH divided by KE plus interest divided by KD. Now again I have a doubt. Sir, previously you taken KO. Why you are considering here KE for equity calculation? Sir, KO because of total organization, sir. Here I am talking about only equity portion. I am talking about equity portion. Sir, on that case, EBAT for total point of view. Here I am talking about equity segment. That's why equity profit is EAESH. Are you guys clear? What about the debt? Individual debt related interest divided by KD. Simple the calculation also. Are you clear? Any doubt regarding this net income approach? Okay, put a heading net income approach. net income approach. Propounded by David Doran. Propounded by David Doran. Akash. Okay. So online students or YouTube watching people, you can ask me questions based on these concepts. You have any doubts? Put a heading assumptions. The heading assumptions. So what's the first assumption? Market have only two sources. Two sources of funds. What are the two sources of funds? Equity and debt. Equity and debt. Second assumption. It's not an assumption, it's common sense also. But they're covered under assumption. That's why I write it down. Debt is cheaper than equity. Debt is cheaper than equity. You can also use the word KE less than KD or KD greater than KE, no issue. Another point, no tax. But if you write here, you will automatically confuse. But you need to keep one point. No tax, this specified assumption. But if they provide in the question, you can take re-assumption. Assumption on assumption. So generally, no tax is an assumption. But if they give, we can consider. That is assumption on assumption. Guys, clear? Don't write that point. If the tax rate is given, consider it. Okay. Next, another point is guaranteed EBIT. Guaranteed EBIT. So write it down. It will be helpful for your MCQs. Guaranteed EBIT. I think you can get a clarity. It's an assumption. Why? Because profit is an uncertain. Sir, clear, sir? Profit is uncertain. But what they're saying that guaranteed. Are you clear now? Next point, sir. Perpetual life. It's a common thing. Perpetual life. Perpetual life. And next assumption, companies following 100% payout ratio. These all are the assumptions you need to follow before understanding the approaches. That is not only for net income, sir. These assumptions are for all approaches. After writing this, put a flower bracket, write down the point. These assumptions applicable for all approaches. So what does it mean for 100% payout ratio? They are not retained anything. If 10 lakhs is came, they will share 10 lakhs. If 10 crores is came, they will share 10 crores as a dividend. Guys, clear? But statistically, companies, what they do in reality, for their future purposes, they will hold some amount. They will share only part of the amount. That's called dividend decision. Yes or no? No. But here is an assumption. All companies need to follow 100% payout ratio. Assumption. We can't do anything. Guys, okay? Now, when it comes to definition or go with the net income approach point. Debt is a cheaper fund. 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 Arrow mark. If company rises, KO decreases due to low KD. If company rises, KO decreases due to, what's the reason for the reduction? Low KD. That related point we already recorded first. That is a cheaper fund. Are you clear, sir? Now, comma, if KO decreases, market value of the firm increases. In brackets, vice versa. In brackets, vice versa. What's the vice versa? Equity is a costly fund. If company rises, KO increases due to increased KE or more KE. If KO increases, market value of the firm decreases. Guys, clear? Now, I already said it's a best example for Vijay Mallya. Why he taken that much of loans? That is a cheaper fund. If I rises, what happen? My market value increases. Are you clear, sir? Okay, done. Write it down this calculation part. Guys, completed, huh? Done. So we will continue next class. Just put at least 5 or 10 minutes every day for revision of everyday class. Are you clear, sir? Nothing is new is there. Every point and concepts you learned in your inter stage. Are you clear, sir? Okay, sir. Thank you.